Following podcast was recorded on Wednesday, August 11th, 2021, featuring Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm Kristen Radosh of Arbor Research and Trading, joined today by our presenters, Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Thank you both for joining us this morning. Today you're going to give us your thoughts on the CPI report that was just released. Jim, can you start us off today?
Yes, I think the CPI report underscored kind of the theme that we've been talking about for the second half of the year. The transitory components like dining out or restaurants, airline tickets, used cars have dramatically decelerated. So their inflation growth rate is approaching zero. That was largely expected. On the other side of the equation, we've got shelter costs are starting to rise. CPI shelter on a 3-month annualized basis is 4.97%. OER, owner's equivalent rent, on a three-month annualized basis is 4% right now. These numbers should continue to rise. They are a much, much bigger percentage of the overall CPI basket than those transitory factors that are coming down. And it sets the stage for the story that we're going to see for the rest of the year. Transitory measures of inflation, which we've been talking a lot about, will start to decelerate, but the more permanent measures of shelter will start to rise, and we'll see how much of an offset that is and where the overall levels of inflation play out. Ben, I'm going to throw it over to you with a question. Why is it taking so long for the shelter numbers to start showing any kind of inflation?
Yeah, so everyone's excited because they see these apartment list numbers that are going, just gangbusters. We have places like Boise with 35% year-over-year growth in rents. Zillow is now playing catch up too, but it's also more smooth like the BLS does with OER. So, owner's equivalent rent is, like you said, the best way to say it's like this big diesel truck. It's just a slow moving beast. So what they do is they're collecting rents for over 30,000 different individual rents, but they only collect them once or twice per year in these panels, January to July, February, August, and so on. And then what they're doing is they're double smoothing. They're taking basically a monthly average and then a 6-month average growth rate. So there's no doubt that OER is going to keep rising. It's just how fast because of this overt smoothing. And what we kind of expect, and we take, like, for example, apartment lists, which we think are more akin to how the OER is measured via the BLS, and smooth that, and essentially take a look at the 40th to 60th percentiles, take the mean, let's get rid of all the wild noise on the outside, the tails, and then let's take, again, a smooth 6-month average, and then we lag it by 6 months. I know it's a whole bunch of gobbledygook just said, but basically think of apartment list smooth, then the lag 6 months, and that shows that OER should be somewhere around 5 to 6% year over year, which doesn't seem hard given the trajectory that you have. You have a great chart here, Jim, that shows how quickly rents have come back to their 2016 to 2019 levels. Some are getting close to 4%. It doesn't seem like that big of a shock that we would see a jump to where we were easily in 2006, 2007, well over 5% here in the near term. So like you said, this is where the confusion is. We have all these transitory issues that are starting to finally abate, and now they might not come down that fast. We're seeing it in some places like used cars and so on, but the stickier side with wages and now in particular rents is going to certainly keep a floor on core CPI, and where that floor is what's most important for investors and most important for policymakers.
Yeah, before we jump to the next question, I'll just emphasize that last point that Ben just made, is that when all of this shakes out, do we wind up with year-over-year inflation after the base effects, on core somewhere in the high 2s or low 3s? And if that is where we kind of settle out, that might be too high. and that might be a problem for the market. It isn't a problem for the market right now, but as we move forward, we could see whether or not, and especially policymakers, if that is something that the Federal Reserve feels like they need to respond to or so. But the point is that I think the narrative that you hear in the financial media is it's only about transitory effects, and transitory effects are going to go away, and that part's true. But we have to remember that there is this big thing, in core CPI, it's 35-ish% of it is shelter inflation, and it is starting to move higher as all these transitory effects start to move lower, and we'll see where it kind of settles out.
Yeah, I think one of the charts that we have that shows this transitory side, and this is what I think is going to be hyper focused on over the next number of weeks, is all of these different surveys and markets that have now peaked between May and July. So here we have some of the most high flyers that we've been watching, everything from spot prices of commodities all the way out to unleaded gasoline, and then we have prices paid surveys and so on in there. Every single one of these away from, I believe it was, I can't remember which one it was here. I think it's container rates that haven't exactly peaked yet, but all the rest of these have peaked between May and July. And historically, when we get a peak at such elevated levels, this is kind of the sign of the end, and we do get a quick retreat that usually it takes about 10 months or so to get back to average. But like Jim said, this is going to be hyper focused on, but this is no longer going to be the most important story. Even though it's kind of been in everybody's news box, email boxes since the beginning of the year. The big thing is the shelter inflation, like Jim said, with this huge weight, and that is going to counteract, and we're going to have to make sure that we figure out where that floor is. And I do agree with Jim. I think if we do have a core inflation that sticks around somewhere around 2.5%, we've already seen central bankers have a quicker reaction function than expected, even though we're in this new AIT regime. Powell during the last press conference and some other governors have expressed concern about inflation, and they're trying to pull in the taper faster than they kind of said they would. Everyone was kind of, months ago, everyone was thinking that we'd get this taper to come, in Q1 2022, but now we have policymakers talking about announcements in August or September. So the reaction function is high, and that's where the sensitivity is going to be to shelter inflation, not to these transitory forces anymore.
I'll remind you that with the reaction function too, that we've talked about this on previous podcasts. If you break down the dots, you could see that in 2023, there are 5 members of the Fed that do not think they will be raising rates through the end of 2023. And there's 5 other members of the Fed that think they will raise rates 4 or 5 times by the end of 2023. A wide difference, meaning that there is no agreement at the Fed as to what to do next. Ben, you've got a chart of that showing the words of agreement and disagreement from Federal Reserve speeches, and their words of agreement are plummeting, meaning that they're very uncertain about what they should do. So, and you've also seen this in the way that Powell has been criticized a little bit over the last couple of pressers and presentations, because his message has been muddled. And I've actually joked that I said, no, actually he's doing his job. He's telling you what the Federal Reserve thinks, and there's no consensus at the Federal Reserve right now. There are people like Bostic and Kaplan, which if they were in charge, we would be tapering now. And then there are people like Mary Daly or Charlie Evans. If they were in charge, we would be tapering in 2024. And so we'll have to see how the Fed takes this information and kind of puts it in. But the point is, they are not a monolith right now among what they should do next.
Yeah, and I think once we do get some, consensus here on taper and the rate hikes, it's going to be interesting to see how quickly real yields decide to finally rise, because they're eventually here going to come off, these incredibly low levels, especially at the short end of the curve. If you look at like 2-year tips, for instance. And I think that once they are able to get that consensus, but then we get some, concern and uncertainty about the inflation and an economic outlook. So it's kind of the opposite. We'll get agreement from the Fed, but we'll have this concern about either the economy or inflation. That's probably going to start to give rise to real yields. And that could also strengthen the dollar. And then that sets up a scenario that's not necessarily favorable for any investor. Because if you get this bounce in real yields, which is going to come at some point, I think in the next number of months, and a bounce in the dollar, that's usually a negative return scenario especially on a risk-adjusted basis for nearly all asset classes. So that's something to look out for on the horizon. And I think at the heart of that is going to be what we're talking about right now, which is shelter inflation.
Right. And I also think if we wanted to look too, when you get that bounce in real yields, because I agree with you that we could see that, it'll probably come, and the narrative around that will be inflation expectations. I've talked about on this podcast before, the dirty little secret is there's really no good model or no good framework for what causes inflation and what doesn't cause inflation. Take your favorite one, whether it's monetary rational expectations or anchoring, unanchoring, and go ahead and test it. It doesn't test very well historically. But the Fed does believe in this idea of anchoring, that as long as people believe inflation is not a problem, it's not a problem. Well, a lot of the surveys continue to move higher. And if with that shelter move up, that you continue to see the Michigan survey or the Fed survey or TIPS break-evens or the Conference Board survey of inflation expectations stay elevated, that will get attention within the Federal Reserve and on Wall Street, because that's the theory that the Fed has been hanging their hat on. As long as people don't believe there's inflation, there isn't inflation. Well, a lot of the surveys are saying people expect the inflation rate to be the highest in a decade or 15 years. And some of the surveys, like the New York Fed survey of consumer finances, which they put out a couple of days ago, are not showing that rate of change peak that a lot of other things are showing, and that should get their attention as well too.
Yeah, what's interesting too, to comment on that real quick, is that usually you get some demographical differences in the kind of tail expectations for inflation, those expecting, for example, 5+% headline inflation. But what's interesting this time around is we're seeing all demographics from 18 all out to the older generations expecting this tail. We have something around 30 to 40% of respondents across all of those age groups expecting 5+% inflation. So that is kind of a sticking point, and that's where it's going to be interesting to see if those can release, just like a lot of these manufacturing surveys are doing and commodities and so on. But like you said, Jim, and I think they will personally, but if we see this gap, and maybe that's something we really need to watch super closely, is this consumer inflation surveys relative to all these manufacturing surveys and TIPS break-evens. If that gap persists, I think more than even 2 or 3 months, which didn't happen after the financial crisis, then we've got this shift in the anchoring of inflation expectations. And that is kind of a mindset difference that we would have relative to the financial crisis.
I agree. And let me start to sum this up a little bit too. I think the narrative you're going to hear is airline tickets are down, restaurant prices are down, used car prices are down. That's it. Transitory's won. Thank you. Drive home safely. It's not quite that simple yet, because there are those slow-moving shelter components that are going to move higher as well too. A lot of people are going to take their feed on this off of interest rates. If bond yields or 10-year yields move lower, then they'll say, look, it's transitory. If they move higher, they'll say it's not transitory. But I do think the final word on inflation has not been said just yet. Also muddled in there too, which was outside the scope of this presentation, is the whole growth story and the Delta variant and whether or not it is slowing down growth. And that you could see being impacting bond yields as well too. But to stick with inflation, we're not going to transition, I think, from the transitory factors have moved us up, and now we'll start to fade to kind of the more sticky components of inflation, like shelter, will start to move up. And how much do they offset each other, and where does inflation eventually settle out once both of these slow-moving vehicles, transitory up and down and shelter up, where does it all settle out at the end? My concern is it settles out at a rate that the Fed will find uncomfortable, but we won't know that until later this year or early next year.
Well, thank you both for joining us this morning, and thank you for all of your thoughts and your outlooks and expectations. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. For any questions, please contact Gus Handler at gus.handler@arborresearch.com.